Are you ready to navigate the stormy seas of 2024's economy? From the precipice of a banking crisis to the quaking grounds of real estate, we're diving deep into the turbulent waters of America's financial future.
Our next story is about the US banking crisis. It seems to be spreading. Yesterday, regional banks in America suffered more losses.
Buckle up as we explore the critical factors that could push the US into an economic tempest. Let's begin. Excessive money printing and monetary policy decisions. Following the economic disruptions caused by the pandemic, the Federal Reserve significantly increased the money supply through quantitative easing, buying up trillions of dollars in government bonds and other securities. This measure was crucial in stabilizing the economy during the crisis, facilitating lower interest rates, and boosting lending and spending. However, as the economy began to recover, the effects of this substantial increase in the money supply contributed to rising inflation rates. By 2021 and into 2024, the ongoing effects of these policies are evident as the Federal Reserve faces the challenging task of managing inflation without stalling economic growth, highlighted by the rapid shifts from easing to tightening monetary policies. This delicate balance is critical in preventing a hard economic landing while addressing inflation, which remains a pressing issue in the current economic climate. Banking sector vulnerabilities. The banking sector in the United States faces significant vulnerabilities, particularly due to the aftereffects of monetary policy shifts and the current economic climate. As interest rates have risen rapidly to combat inflation, the increased cost of borrowing have started impacting the profitability and stability of banks. This scenario is compounded by substantial mark-to-market losses on bond portfolios due to higher interest rates. Moreover, banks are bracing for potential defaults, especially in the commercial real estate sector, where lower occupancy rates and rising costs could lead to significant loan losses. These factors, combined with the historical context of the 2020 pandemic response that led to an excess of cheap money, create a precarious situation where financial institutions are increasingly exposed to the risk of a banking crisis, similar to those seen with the collapses of major banks in recent years. Overarching economic challenges. The overarching economic challenges facing the United States as it heads into 2024 are multifaceted and significant. A key issue is the slowing GDP growth, which, despite ongoing consumer spending, has not kept pace with previous years' robust figures. This slowing growth is attributed to various factors, including decreased government spending and investment, as well as rising import costs that subtract from the GDP. These economic headwinds are exacerbated by the aftermath of aggressive monetary policies, which, while intended to control inflation, have also heightened the risk of a recession if not managed carefully. The economic landscape is further complicated by global uncertainties, such as geopolitical tensions and trade disruptions, which continue to pose risks to the stability and growth of the U.S. economy. Global risks. Global risks loom large over the U.S. economy as it enters 2024, with geopolitical tensions and economic slowdowns abroad posing significant threats. Increasing conflicts in critical regions like Eastern Europe and the Middle East disrupt global supply chains and energy markets, potentially leading to spikes in oil prices and further inflationary pressures. Additionally, a slowdown in China's economy, a major consumer of global commodities, could have far-reaching effects on global trade and economic stability. These international challenges, combined with domestic economic uncertainties, create a complex web of risks that could impact the U.S. financial system and overall economic growth. Debt levels and interest rates. Debt levels and interest rates in the U.S. are intricately linked, presenting a significant economic challenge as the country moves into 2024. The U.S. government and consumers have accumulated high levels of debt, facilitated by historically low interest rates over the past years. As the Federal Reserve has raised interest rates to combat rising inflation, the cost of servicing this debt has increased for both the government and private borrowers. This situation strains federal budgets and personal finances, potentially leading to reduced spending and investment. Higher interest rates also slow the housing market and consumer borrowing, which can further dampen economic growth and increase the risk of a broader economic downturn. This delicate balance between managing debt levels and controlling economic growth through interest rates is a pivotal aspect of the current financial landscape. Real estate vulnerabilities. The real estate sector in the United States is facing increased vulnerabilities as we move into 2024, primarily driven by the fallout from high interest rates and changing market dynamics. The residential market, previously buoyed by low interest rates, is experiencing a slowdown as higher borrowing costs deter potential homebuyers, leading to a cooling in home sales and price growth. On the commercial front, the landscape is even more precarious. The shift towards remote work has significantly reduced demand for office spaces, leading to heightened risks of defaults on commercial real estate loans. This is particularly problematic for regional banks with substantial exposures to these loans. The combined effect of declining property values and reduced occupancy rates is putting additional strain on an already fragile real estate market, increasing the likelihood of a financial ripple effect through the broader economy. Disrupted supply chains. Disrupted supply chains continue to pose significant challenges for the U.S. economy as it approaches 2024. Initially strained by the pandemic, these disruptions were further exacerbated by ongoing geopolitical conflicts and trade tensions. Such disruptions impact the availability and cost of goods, leading to increased production costs and contributing to inflation. Industries, particularly those reliant on complex international supply networks like electronics and automotive manufacturing, face delays and increased operational costs. Additionally, recent geopolitical tensions, particularly in Eastern Europe and the Middle East, threaten stable access to critical resources like energy and raw materials, compounding the uncertainty and inefficiency within global markets. These ongoing disruptions highlight the vulnerability of interconnected global economies and underscore the need for more resilient and adaptable supply chain strategies to mitigate such risks. Federal Reserve's policy dilemma. The Federal Reserve's policy dilemma in 2024 centers around managing the trade-off between curbing inflation and supporting economic growth. As inflation reached multi-decade highs, the Fed responded with aggressive interest rate hikes, the fastest in the post-war period, to temper inflation. However, these rapid increases in rates have introduced new challenges, particularly the risk of pushing the economy into a recession. High interest rates make borrowing more expensive, which can reduce consumer spending and business investment, critical drivers of economic growth. The Fed now faces the complex task of possibly easing these policies without reigniting inflation, navigating an economic landscape fraught with high debt levels, vulnerable banking sectors, and external geopolitical risks. This balancing act illustrates the significant strain on the Fed's decision-making processes as it aims to stabilize and grow the U.S. economy without precipitating further financial instability. Technological disruptions and job market shifts. Technological disruptions and shifts in the job market are significantly shaping the economic landscape as we head into 2024. Rapid advancements in technology, such as automation and artificial intelligence, are restructuring various industries, leading to job displacement in traditional roles while simultaneously creating new types of employment opportunities. This shift often requires a new set of skills, thereby affecting labor markets and contributing to wage disparities. While these technologies improve efficiency and productivity, they also pose challenges in terms of workforce adaptation and the potential widening of income inequality. The need for substantial investment in education and training programs to equip workers with necessary skills is becoming increasingly important in mitigating economic instability caused by these technological changes. That's all we have for today. If you want to stay updated with more insights like these, don't forget to hit that like button and subscribe to our channel. Your support helps us keep bringing you valuable content, so click that notification bell too, so you never miss out on our latest videos. Thanks for watching, and see you in the next one.